Hi, I'm Ben Reppond. Welcome to my update. This will be a stock market update today. We do every other week. This week will be the stock market. Next week we will include economic indicators, which gets into inflation, the Fed, debt, etc. So we'll cover the stock market today from various perspectives. And I promised last week that I would include a segment on currency that's back in the 1800s, about 150 years ago. And I think you'll find that interesting. And I found a correlation between what was going on then and what's going on now, and I'll point that out. So let's get into the stock market. This is a 12-month chart. It's a weekly chart. So every move in the market, every move up or down, is the equivalent of 1 week for the S&P 500, represented by the exchange traded fund SPY, SPY. And you can see from this that for most of, let's say about 10 and a half months of the S&P 500, it had a pretty consistent trajectory or trend that was going up. We don't know the future, so we only know the past and the present. During the past 6 or 7 weeks, beginning with the 2nd of January, the market has pretty consistently gone down, and this shows you that it's done a couple of things. One is it broke the 20-period moving average and is headed down. That's a bearish sign or an indicator of a negative market. And it also broke its own trend line. So that until it changes that direction, it shows that it has momentum and direction in a downward direction. This is a dashboard that I put together that shows the top 4 show the indexes of the major averages in the U.S. stock market. They cover DIA on the left. DIA stands for the Dow Industrial Average. QQQ is the NASDAQ 100. SPY is the S&P 500. And IWM is the Russell 2000, which is the smallest 2,000 companies in the stock market. Below that are EFA and EEM. EFA is the developed, generally speaking, it's an ETF for the developed countries. And EEM is an ETF for the developing or underdeveloped countries. So I put in a yellow box the top 4, which is the U.S. Major indexes from different perspectives. All of those cover a different segment of the market. Those indexes, relative to their moving averages, are all in negative territory. They're all below their moving averages. So whether it's and this is for the daily chart, by the way, the 20-day moving average, the 50, the 100, and the 200-day moving average, they're all below those averages. That is definitely negative, and it is an indicator from all perspectives, using the moving averages as a point of reference, that they are all moving in a downward direction. So this is as of Friday. Now, that can change, so we know that to be aware that it can change. At some point, it's going to change direction. When it does change direction, the first thing it will do is start to break through one of those averages and move up. When we get to the foreign markets, the developed countries, EFA, again, similar to the U.S., all moving averages, it's below all of them. EEM, which has been down for a long, long time, has actually one of them, the 20-day moving average, it's actually broken above that average. So that one's green. It's the only one that has one green indicator. That doesn't mean it's necessarily the most positive, but for this time period, it was slightly above the 20-day moving average. So this whole chart shows you, you can see the rates of return for all of those periods, the month and the quarter, the year to date, the percentage, all of them are negative. So at some point that's going to change. But right now, that perspective of the market is negative and moving into bear territory. I do a comparison. This is a relative strength or relative chart where I show in this case, the growth index. This is a Vanguard Exchange Traded Fund, ETF. VUG is the name of the ETF. And it is, the line is numerator, VUG, denominator, SPY, the S&P 500. So the more it moves down, the more it shows that the growth index, growth stocks, are negative, or they are weaker than the S&P 500 by that degree. And of course, if it moves upward, then it shows that, during this period of time, it would be stronger than the S&P 500. So it's a relative chart. And you can see for almost a 6-month period of time that the growth stocks, the growth index, VUG, is negative, or it's moving in a downward direction more so than the S&P 500. We know that I've already shown you this, the S&P 500 is moving down. This is moving down even faster than the S&P 500. We could have substituted QQQ, the NASDAQ 100, which is a growth index, for VUG, and it would look similar. So whichever growth index it is, it would look similar to this. Now I'm going to compare the small cap index we saw in an earlier chart, that IWM, Russell 2000 small cap index, is negative in all categories. This is a relative chart showing the relative strength of that compared to the S&P 500, so it's relative. So you can see for probably over 6 months, it looks like about 7 months, that the small caps have moved in a downward direction more so than the S&P 500. Now I'm going to jump over to bonds. Now we've been looking at a 12-month chart. Now I'm going to look at a 24-month chart. So I'm going to stretch out the period here for a 24-month period. I'm doing this to show you, to give you a perspective on bonds. I want to make some comments about this. So you can see that the long-term government bond, represented by the ETF TLT, has moved down. And I've been making this point that it is not serving as a counterbalance to equities in the way that it has most of the time during the last 40 years. I'll come back to that. So you can see during the first year of this 2-year period, a very strong downward direction. This is an absolute chart, not a relative chart. So this is just showing the ETF TLT. Downward direction. Then it goes up a little bit. And then during the last month and a half, approximately during the time when stocks have been going down, this has also been going down. You can see at the end of the chart. So I circled the first period and the second period so you could see the degree to which government bonds are dropping. Why are they dropping? Interest rates are going up. And as interest rates go up, government bonds come down. They are completely inversely correlated. Why does this matter? Well, the traditional method of investing used by traditional investment advisors is you put some bonds, usually that means government, high quality AAA rated bonds or bond funds or bond exchange traded funds, ETFs. You put those in some combination together with equities, stock-based funds or stocks. And the idea is that the bonds will serve as a counterbalance to equities, and it will soften the degree of risk related to equities. That has been conventional thinking for a long, long time. So for the last 40 years, approximately the 1980s, when interest rates were near 18%, interest rates have been coming down from 18% all the way to almost zero. What that means is that during that 40-year period, bond prices in general, the price of them, not the yield, but the price has gone up because the yield in the bonds is very similar to interest rates. It has also come down. As it came down, bonds went up. However, now that bonds have hit their bottom, we think it's a bottom, of zero interest or zero yield, and the interest rates are at 0% approximately, they have nowhere to go but up. This assumes that you don't believe in negative interest rates. And as that happens, what has been the traditional method used by traditional advisors is that the protection that bonds are going to give you against equities is not going to be what it was for the last 40 years. Prior to 1980, in the 1980-82 range, prior to that time, for the previous 30-year period, going back to about 1950 to 1980, interest rates rose during that period of time, and bond prices, government bond prices, declined. So the traditional financial advisors, generally speaking, were educated and draw their knowledge base from the last 40 years of stock market and bond market history. So they have not been schooled in what do you do in a prolonged rising interest rate environment. I don't believe they've been schooled in it, because what they're doing is what they have been doing a lot, is putting bond funds together with stocks or stock funds. I get to see this because other people show me their portfolios. I see what they're invested in. I see the amount of bonds that are in there or bond funds. And what's happening, you can see, is that particularly in the right side of the chart, is that as stocks have come down, we just covered that, so have bond funds, government bond funds, come down. They are now starting to be correlated. The traditional advisor industry does not have an answer for this. They don't believe in shifting and making changes, generally speaking. And if you're seeing them make changes and have gotten you out of bonds in the last year or two, then that would be an exception. Most of them believe in just stay the course. You ride it up and then you ride it all the way down. That's their thinking. And of course, we don't believe that. I don't believe this is the right approach. So that will give you a picture of not only bonds, but it will give you a picture of the traditional investment advisor modeling and how flawed it is. Okay, Askberry Research has several indicators. There's different ways of looking at the market based on their research. And this is what they call the Askberry 6. And it has 6 different unique indicators showing either green or red, showing, they're positive indicators or they're negative. All 6 of their indicators, not any different from that previous chart we looked at, all 6 of them are negative. And, when things turn positive, they will turn positive one by one. This is a look. Then they break the stock market down, and actually you could even say the S&P 500, they break it down into the various component parts. In the S&P 500, there are 11 sectors, different aspects of the economy. And I'll just go down a few of them in the list: financials, energy, technology, utilities, industrials, consumer staples, etc. There are 11 of them. They're all aspects of our economy. And they show this is kind of an asset flow methodology, showing not necessarily the movement of the index or the movement of stocks in that sector, but the flow of money going into that sector or out of that sector. And sometimes that is definitely different than the movement of price. So it's an indicator. So the two that are the most dominant are at the top. Financials, this would be companies, JP Morgan, Citibank, Goldman Sachs, the brokerage firms / banks that make up the financial sector. Energy, which is made up primarily of oil companies, is positive in 2 of the 3, the monthly and the quarterly. So that shows strength. The flow of money is going into those sectors. And if you look at them, the financial sector is actually down. All stocks except energy stocks are down. And so the financial sector is down, but it's down less than the S&P 500 and less than many of the other sectors. The energy index, represented by the ETF XLE, is positive for the last 6 months. It's the only sector in the stock market, the only sector which is positive. All the others are negative to one degree or another. So it's a way of looking at this. Those that are negative, and they do 2 of each. The most negative in the weekly are technology and consumer staples, and in the monthly, technology and consumer discretionary, and in the quarterly, consumer discretionary and communication services. So the rest of them they're not necessarily neutral, but there's not as much of a flow of money going in or out of the other sectors. And these can change from week to week or month to month. Flow of money changes from sector to sector and one type of stock to another type of stock. Okay, this is a relative chart showing the cross-asset relative performance. So I'll go through this because it shows that from a performance standpoint, now I'm going to shift back from flow of money over to performance. Which one is better, this or that? And you can see where the strength is going in one direction or another. Which one's better, stocks or bonds? I've already shown you how bad bonds are. Stocks are worse. So yeah, bonds are going down, government bonds, but stocks are going down more. So bonds are favored in all 3 categories: weekly, monthly, and quarterly. High beta or low volatility. High beta stocks are actually doing better than low volatility stocks. Large cap or small cap. Small cap is doing better, but there's not the as strong of a emphasis in that direction. S&P 500 versus the Dow, in all cases the Dow. And we've looked at this before, the Dow representing more the value stocks, and the S&P 500 is a mixture of growth and value. S&P 500 versus the NASDAQ. So again, the S&P 500 is a mixture, and the NASDAQ is both growth and value. And I've shown you how bad, on that early chart, shown you how bad the growth stocks are doing, or growth indexes, and the NASDAQ 100 is one of those. And so again, as bad as the S&P 500 is doing, it's doing better than the NASDAQ 100 or growth type stocks. Our growth or value, same kind of thing, except here we take the S&P 500 and we split it into these 2 categories of growth only or value only. And of course, value is doing better because growth, meaning the NASDAQ 100 type stocks, are doing worse than those that are value. U.S. or developed markets. Developed markets. This would be Europe and parts of Asia, mostly Japan and South Korea. And which one's doing better, U.S. or emerging markets? And we saw that the emerging markets in that early chart, the emerging markets were starting to turn positive. We saw that one green light on emerging markets. It was the only green light on the dashboard. And they're starting to do better than the U.S. stocks in general. So in all three perspectives, time perspectives, the emerging markets are better than the U.S. market, meaning the S&P 500. Now let's go over to fixed income. Fixed income meaning bonds. Government or corporate bonds, which one is doing better? As bad as government bonds are doing, which I've covered, corporate bonds are doing worse. So relatively speaking, government bonds are favored over corporate bonds right now. High yield or corporate, that's mixed. The first two categories, corporate is doing better than high yield, and the last category, high yield, is doing better. But and then which one is doing better, short or long-term bond, and the last two categories where there is a stronger emphasis, short-term is doing better. This compares the U.S. to other countries. And which one, this is performance again, which ones are performing better? And there is an ETF, it's in the second column for each of these countries. So you can see a long list of countries, and then down toward the bottom you can see regions in the world, the Eurozone, Pacific, and emerging markets. And the ETF for all of them. And then you can see which ones are performing better, and in most cases, the vast majority of cases, performance is better whether they are a developed country or a developing country. They are doing better than the U.S. We've seen this chart, I think it was about 5 months ago, that was nearly all U.S. The performance has shifted, and now both developing and developed countries are doing better than the U.S. I put Russia down here because that is the only exception where the U.S. is doing slightly better than Russia. But in all other cases, all or some of the others, or most of the others, are doing better from a performance standpoint than the U.S. We're going to spend some time on currency, and I don't want to get into the economy. I'll do that next week. But the two aspects of money, one is the printing of money done by the Federal Reserve, and that's called the Fed. And this chart goes back to 1981. And so from 81 to present, this is about 40 plus years. You can see this is M2, which is a representation of it's the amount of currency in the system. So the more this goes up, the more currency there is in the economy, the less it is lower value. It's going to diminish in value if you raise the amount of currency in the system. So the far right of the chart, I circled the last 2 years. This goes back to March of 2020. So with the pandemic, the Federal Reserve took a very active role in pumping extra money into the system. Now, the goal was for that to help the economy. Do you think the economy is a lot better because the Fed pumped more money in? No, it's not better. I mean, maybe a little bit, but there's a lot of indicators that show it's not better than 2019. So where did all that money go? I'm not going to get into that. I just want to point out that there is a lot more printing of money, and what that means is the value of the dollar is diminished. What does that mean? That means inflation. What are we reading about? Inflation is out of control. So why is it out of control? Look at the far right of the chart. That tells you right there. That tells you all you need to know. So before inflation really took off, maybe the last 6 months, before that happened, if you cut off the last 6 months of this chart and inflation was not where it is today, you could make the assumption that inflation is in our future. And of course, I made that statement. Try to stay away from predicting the future, but this was flashing red lights. Look out, inflation's in your future. 6 months later, here we are. So that's one issue with our currency. It is being devalued through the printing of extra money. The second issue that we've got is debt. We have a big weight on our back as a country. And by the way, we're not the only one. Every other country, developed and developing countries, have the same problem. And by the way, they also have the problem of printed money. So we're all in this together. It's a matter of degrees. We're in the upper group, which is the worst group to be in. But there are 7 or 8 that are more than us. Certainly in the debt category, and there are many that are definitely in the printing of money category. So it's not a U.S. only issue. So this chart, the previous chart told us there's almost 22 trillion of money in circulation, up from a fraction of a trillion. This tells us in the upper left corner, I circled in blue, 30 trillion in debt. And how much is it increasing? You look at how much money are we taking in, just go to the right in the black box, we're taking in about 4 trillion in revenue. The pink box, go back to the left, second row, the pink box tells us how much money we're spending. We're spending 6.9 trillion. Now, you would not run your household that way, but we run the country that way. So we're borrowing $2.8 trillion. We're in the hole, 2.8 trillion. So this 30 trillion is moving at a faster and faster rate. And of course, we also have to pay interest on our debt. So as interest rates go up, so does the interest that we pay, higher and higher on higher amounts of dollars. So the weight of debt, just like the weight in your household debt, if you had too much debt, it would be a problem. It would show up in many ways. And so in the printing of money, you got too much money in circulation, creating inflation, and here you have a weight on our back, slowing us down from growth, which is debt. And so both of them do different things, but neither one are positive, and they're both moving in the wrong direction at a faster and faster rate. So what can you do about it? Well, the only thing that's out there that's helpful in the long run is hard assets. And the easiest way to get hard assets that hold their value is precious metals. That's gold and silver. I've talked about that before. There are people who advocate buying gold and silver all the time. No matter what the question is, the answer is gold and silver. So right now, I don't sell gold and silver, but I'm telling you that if you're looking to protect the value of the dollar over the long term, the only answer is hard assets that hold their value. And the easy one there is gold and silver, although there are other assets that actually do hold their value. Last week, I mentioned this book, and I recommend it. It's a very good book. It's written by a Dutchman, Willem Middelkoop, and it was written 8 years ago. And it's as if he was forecasting the future, which he was, but he didn't know, I don't think, that it would take 8 years to get here. So what he's talking about in the book is upon us. He just told about it 8 years ago. I got an email from one of our viewers who said, in essence, I'll paraphrase, thank you for sending this. I immediately ordered the book and read it. It was fantastic. It helped me understand the Fed like I never understood the Fed. And I'm going to read it again. And it's less than 200 pages. It's very easy to understand. If you don't want to dig into this area, certainly shouldn't buy it. But if you have curiosity about how money works, and particularly debt and the Fed and so forth, currency, it's a valuable book. And here it is. Think about this. This is a Dutchman from the Netherlands writing about the United States Federal Reserve Bank. He's telling us things that most people don't know about, and he's correct. What's in that book, in my opinion, is correct. And he goes, of course, into inflation and precious metals and a variety of things. But it's a good book if you're interested. Next, I want to cover gold and silver. Each week, I cover this to just point out the prices, the direction of the prices of gold and silver. What's happened, of course, we know if you look back over the last 6 weeks, the stock market, as we've shown, has gone down and down and down for the last 6 or 7 weeks. And, some indexes more than others. What's happened to gold and silver is gold and silver has gone up in the last, it's stabilized, held its value, and now it's rising. When the market, the last week, the last month, whatever, the last week, market's gone down still, now gold and silver are going up. They're not only holding their value, they are increasing in value. So when I make the case for that, if you want something that holds its value, particularly in the midst of declining value of the dollar, gold and silver do that. So the price, $1,899 for an ounce of gold. That's really gold bullion. If you went to a gold eagle, that's different. And then the price of silver, $23.93, silver eagle, more, plus the markup. But this is what's called the spot price, or the price of the pure asset itself, before there's a markup put on there or the use of silver eagle. Gone up. Gold 4.2%, silver 3.9% in the last week. So that's an example. Sometimes it goes down and sometimes it goes up. Gold and silver, they do their own thing. But it's hard for those who are wholesaling this and those who control the pricing of it to hold it down much longer. It's now starting to rise. How far is it going to go? It goes up and it goes down. But over time, it holds the value of the currency, in our case, the dollar. I mentioned last week that I would do a segment on currency, on old currency. So this is a picture of $2 bills. If you were to go to a merchant and hand either one of these to the merchant, they would accept it. However, there is a difference. There's an inherent difference. Not an intrinsic value difference, but there is a difference. The one on top has at the very top of it the words silver certificate. The one at the bottom says Federal Reserve note. Well, Federal Reserve implies those are good sounding words. They don't mean anything. It means it came from the Federal Reserve and it's neither federal nor reserve. The word note implies that it has, it's redeemable. It has value. In 1878, the dollar was authorized to have the words silver certificate on it. That lasted from 1878 to 1964, I believe. And then they stopped putting the word silver certificate. You may say, what does that mean? Silver certificate means that, and this is what they intended, because in 1878, people were carrying silver or coins in their possession, and it was cumbersome. And so they came up with an arrangement that if you'll give us your silver, we will give you a silver certificate, and that certificate can always be redeemed in silver. So you can exchange it. It's an assurance that it is backed actually by silver. So the equivalent, whatever the price is, let's just say it were, just pick a number and say it was $5 an ounce. You would take 5 of these, but you actually could get silver for it. So they stopped that in 1964 and started printing the Federal Reserve note. And as such, since 1964, this dollar is not actually backed by silver. It's really not backed by anything. Now, we do have gold on in deposit in Fort Knox and in the basement of the vaults of the New York Federal Reserve building. And I don't know where else they have it, but it's reported that we have about 8,000 tons of gold in reserve in this country. Now, that has never been audited. They don't seem to want to audit it or to release that data. So, being the skeptic that I am, I wonder if we really have 8,000 tons. What happened before, this is an interesting kind of history lesson. What happened before, our gold reserves were depleted about 50% from 1944 to 1971. So in that period of time, from 1944, we agreed with other nations, 44 nations in Bretton Woods, New Hampshire. We agreed, it's called the Bretton Woods Accord. We agreed with them that we would be the world reserve currency, and we still are. They asked for one condition. The condition is that we would back our currency with gold, our gold and silver, hard assets. And we agreed to that. So in other words, you could exchange those dollars for hard assets. After World War II, what was happening is we were buying goods from Europe, mostly. And they were accumulating more and more and more dollars. So they had the idea, smart of them, to bring those dollars to the U.S. and exchange them for the gold that supposedly backed them. And so the Netherlands and Germany and France and I don't know what other countries, I know those 3 in particular, they put ships, they put dollar bills in whatever denomination, physical dollars, this is before digital dollars, physical dollars on ships, sent them to the U.S. and exchanged them for gold. Load those ships up with an equivalent amount of gold and take them back to Europe. They were emptying the vaults in the U.S. And our 16,000 tons went down to about 8,000 tons. It was depleted about in half until President Nixon in 1971, I think it was August of 71, said no more. And whatever ships were en route to the U.S., he told them, turn around and go back to where you came from because you're not going to get any more gold. I'm breaking the accord. I'm canceling that deal, executive order, no more. And we have been off the gold standard since 1971, and thankfully he took us off. We want to go back onto the gold standard, but in that case, it was beneficial because in a very short period of time, our vaults would have been emptied of gold. We would have absolutely nothing. Today it is reported that we have 8,000 tons of gold. So I'm thinking from 1971 to present, I don't know how much gold we've added, but when you look at the buyers of gold in the world, it's primarily China, Russia, and India in some combination, are buying virtually all of the gold that is produced, and China is even going to other sources, other countries that are willing to sell gold and buying that. I don't see the U.S. listed in anywhere that they have been accumulating gold. So it looks to me, if the data I'm looking at is correct, I assume it is, that we have not added to our gold supply. However, when you saw that earlier chart, you saw how much dollars have expanded to be in circulation. And so when I say it's backed by nothing, I don't mean it's backed by nothing because I don't know how much gold we have in reserve, but it looks like as the expanded supply of dollars are out there, new amounts of gold are not being added. While at the same time, China is buying all that can be produced both in China and elsewhere. Same with Russia, same with India. And you may say, well, if it's in high demand, why isn't the price going up? And I would tell you, I think it's manipulated. It's manipulated so that those countries can buy in at lower prices, and maybe the banks can buy in at lower prices. They're telling you not to buy it, but believe me, they're buying it. And so you can tell that it's in high demand because the markup on top of the spot price is going up. And that varies between $4 or $5 for a bullion all the way up to $10 or so for silver eagles. I'm talking about silver eagles now. So the first dollar was printed in 1935 and is actually used to be backed by silver. But if you went today and tried to get that, let's say the price is $23 and you gave that and said, I want silver, you're not going to get it. The last one, same thing, you're not going to get it. I go back to the 1860s. The 1860s was a Civil War. Now, this is not about a political statement about the Confederacy. I'm not dealing with that at all. I'm trying to make a point about currency. So the Confederate States were formed in started around 1861 when the Civil War began, and they printed their own currency. They printed their currency and exchanged it with their citizens for silver and gold. And so they used that to finance the war. They probably also obtained some US dollars or Union dollars at the same time, but they had to finance their war effort. They were basically they weren't a country yet, they were a group of states, and so they printed their own money in order to finance their war efforts. On this currency it says that this is redeemable if we sign a peace treaty. And what that means is we basically win. We win the right to become a sovereign nation and to secede from the United States or the Union. And but it's conditional. So in other words, this currency is backed by nothing, and it's conditional on winning the war or signing a peace treaty. And it's redeemable, if you read the fine print, it's redeemable in stocks and bonds. In other words, paper is redeemable by more paper. There's nothing behind it. There's never, and in some cases they had to pay interest rates that went from 6% to 8%. I found in some of them that they contained interest-bearing notes. And the closer they got to the end of the war, the higher the interest rate. And the further out they would potentially redeem them. And then I have some more. And they were issued by the Confederate States of America, which was based in Richmond, and banks and cities and states all issued currency to finance their debt. And here's some other examples issued by states, and one is by a banking company, and so I have a collection, and so in some cases it's cities, states, and banks. And they all have this clause, redeemable in stocks and bonds if and when we win the war, in so many words. So what is the point of showing you this? The point of this is to say, here we are today. Is it really any different when you think about it? It's just paper. It has no intrinsic value. And all of this paper, it may have a collector value, and so because they're not making more of it, You know, it's not authentic ones. It's redeemable, or it's not redeemable for anything of value other than its collector value. So after the war, 1865, it became basically worthless. And so here we are today. So I think about this, and I think of the parallel today, and you think, today the currency is really not worth anything unless you and I agree that it's worth something. If we agree that if I give you dollars and you accept those in exchange for goods and services, then that has value. As soon as you don't accept what I'm offering in dollars, it has no value. It's worthless. It's a piece of paper, just like these are pieces of paper. And whether it says I'm going to redeem it with more paper or I'm going to put interest on there with more paper, it's still paper. So this goes back a long ways. And I won't go through the history of currency, but I've read a lot about it. It's very interesting to me how all of the countries, all of the civilizations prior to our civilization the currency has all collapsed. It's all collapsed because they reverted to, they either filled it with filler, which is usually lead, copper, nickel, non-precious metals, or they went to paper. I do want to tell one thing because it's on my mind. I think it was when Kublai Khan was he was I think the nephew of Genghis Khan. He was the emperor in China. And so I think it was the 1200s. And Marco Polo was coming from Italy. He'd been a merchant from Venice. And so he was traveling over the known world. And so he traveled to China to sell the goods that he had to sell from Italy. And he goes to China and realized that, and he's used to dealing in gold and silver, and he realized that they were not dealing in gold and silver. What Kublai Khan did, as the emperor of China at that time, is that this sounds weird, but you can read about it, they were breaking the bark off of the mulberry trees and writing on them the inscription that this is currency. This is Chinese currency. And he thought, this is crazy. This is crazy. This guy's going to own the world because these people are actually accepting the bark off of the mulberry trees with writing on it as currency. And he was used to dealing in gold and silver that, of course, had intrinsic value. And we laugh about that today, but how different are we than that? They're just running printing presses. Actually, it's gotten worse. We're not only running printing presses, we only do that to replace currency. We expand currency digitally. We just hit a button, or somebody hits a button in the Federal Reserve, and poof, $1 trillion appears in our economy. It's all digital. You can't go get it in dollars, and you certainly can't get it in precious metals. It's worse than Kublai Khan writing the currency value on a piece of mulberry bark. Think about it. So the reason I show this is to just show how transitory currency is. Paper currency that we rely on is worse than this. It's digital, which means it can disappear by the trillions of dollars like that. It can be created that quickly, and that's what they do. It's not politicians, it's the Federal Reserve. And so I hope I don't get banned from YouTube for saying that, but that's the truth. Saw this. Worst case scenario, the Fed saves us, right? I'm not so sure about that. So the printing of money may have prevented us from collapsing further, beginning in March of 2020, the expansion, that chart that shows you how far it's expanded, the activist Fed, may have expanded the rate of currency coming into the country, but I'm not so sure that we're not going to pay a very big price for that. Thank you for watching. If you have questions or comments, leave them in the comment section below. I will answer them. Thanks to those of you who have reached out and sent me emails or text. I appreciate that. And I will see you next week, and we will speak on my insights on the economy and, of course, the stock market. Thank you.